Hey there! You've probably heard about cryptocurrency before. You might know names like Bitcoin, Ethereum, Solana, or Dogecoin. Yep, those are cryptocurrencies. A lot of people buy them as investments, hoping their value will go up. Some also use them as a form of money to buy and sell things. You might have seen how the price started really low and then shot up. Some people made a lot of money, but others didn't. So, what exactly is cryptocurrency? How does it work? And what do terms like blockchain and a mining end mean? The word cryptocurrency comes from crypto and currency. Crypto refers to cryptography, securing information, while currency means money. Cryptocurrency is digital money secured by cryptography and exchanged through a computer network. It has no physical form. What are the difference between cryptocurrency and the money in my banking app? Traditional currencies are controlled by central banks and require banks or payment services to send. With cryptocurrency, you can send money directly to a friend without a middleman, like a bank. Crypto's modern story began with Bitcoin in 2009 by the pseudonymous Satoshi Nakamoto. Nobody knows who he is. Unlike traditional currencies controlled by central banks or governments, cryptocurrency was created to allow direct exchange without central authority. So yes, cryptocurrency was made to be used as money. Buying, selling, sending, receiving. Over time, many people treat cryptocurrency more like an investment. In some countries, like El Salvador, people still use it daily. Most people avoid using it as currency due to volatility, like a coffee costing 0.001 BTC today but 0.02 BTC tomorrow. So most prefer traditional currency for spending and crypto for investing. That's the basic definition and history. Let's move on. Cryptocurrency works using blockchain. Imagine a notebook where every transaction is written and locked, can't be erased or changed. Everyone in the network has a copy of the notebook, so no one can cheat or tamper with it. Each page is a block. When full, a new page is added to the chain, hence blockchain. When a transaction is made, a network of computers validates it by solving a hard puzzle. Once confirmed, data is added permanently to the chain. People who solve these puzzles and validate transactions are miners. The system rewards them with new coins, and this is mining proof of work. Now, here's the big question. Is cryptocurrency a good investment? The answer depends. Some people made a lot, others lost a lot. For example, 500 in 2016, 60,000 2024. Proof of long-term growth. Big profits, big risks. Buy high, sell low, and you lose. Stay sharp. Then, prices rose again to around $70,000 in 2024. This kind of swing happens often in crypto. When the media announced a major Bitcoin ETF launch, excitement grew and price surged as more investors jumped in. When a government announces restrictions or bans, uncertainty can push prices down, like when a ban was announced and Bitcoin dropped. Crypto volatility is influenced by supply and demand, market sentiment, regulation changes, tech development, manipulation, and more. The biggest drivers are often speculation and popular narratives. People chase trends hoping for quick profits. Media hype can amplify moves upward. But when doubt spreads, panic selling can trigger sharp drops. Sentiment can flip quickly. Optimism today, fear tomorrow. Another reason crypto is hard to predict. FOMO makes investors buy just because prices are rising, without fully understanding the asset. FUD can push people to sell in panic on scary headlines, sometimes at the worst possible moment. Chasing every move is risky. Understanding fundamentals and risks is more important than following hype. A long-term mindset and risk management often help investors avoid emotional decisions in volatile markets. Big potential returns, but high risk and volatility. Know what you're doing before you jump in. Now let's cover common crypto terms you'll see everywhere to make the concepts clearer. Bitcoin is the first and most known cryptocurrency, often called digital gold. Its supply is limited. An altcoin is any cryptocurrency that isn't Bitcoin. like Ethereum, Solana, and meme coins such as Dogecoin. A wallet doesn't hold your coins, it holds your public and private keys. Protect them, or you lose everything. The public key is like your address for receiving crypto. The private key is like a password. Keep it secret. Sometimes a blockchain can split into two different paths. This is called a fork. After a fork, two versions of the blockchain can continue separately, each with its own rules. A soft fork happens when changes remain compatible with older rules, so most users stay on the same chain. A hard fork creates a permanent split, forming a new chain that is not compatible with the original rules. For example, Bitcoin once split into Bitcoin Cash, a hard fork made to support faster transactions. Now that you understand forks, let's explore how blockchains stay secure without massive energy use. Proof of stake is another method to validate transactions, using staked coins instead of energy-heavy mining. Participants lock up coins to help secure the network, and in return, they can earn rewards. Unlike proof-of-work mining, proof-of-stake systems use far less energy to secure the blockchain. Now let's talk about wallets and how people store their crypto safely. A crypto wallet doesn't store coins. It stores your public and private keys to access coins on the blockchain. Hot wallets keep keys online for easy access. More convenient, but more exposed to hacks. Cold wallets keep keys offline. Safer from hacks, but less convenient for quick use. Choose wallets based on your needs. Convenience for small daily use. Security for larger long-term holdings. If you lose your private key or recovery phrase, you can permanently lose access to your crypto. A man reportedly lost access to 8,000 Bitcoin after the hard drive holding his private key was thrown away. Your public key is for receiving. Your private key is like a password. Never share it with anyone. Next, let's look at the advantages and disadvantages of cryptocurrency, so you can see both sides clearly. We'll cover decentralization, accessibility, flexibility, privacy, and potential high returns. We'll also talk about volatility, illegal transactions, regulation uncertainty, scams, and lack of consumer protection. Cryptocurrency has clear advantages and disadvantages. Let's cover both sides so you can judge fairly. Understanding the benefits and risks helps you avoid bias. This is an educational overview, not financial advice. First, decentralization. No single central bank controls the network. Second, accessibility. Anyone with internet can participate without complicated banking steps. Third, flexibility. Crypto transfers can happen 24/7 across borders without bank hours. Fourth, privacy. Transactions can be more private than traditional banking, though not completely anonymous. Fifth, potential for high returns. Some coins have risen dramatically in certain periods. The biggest disadvantage is volatility. Prices can swing sharply up and down in short periods. Privacy features can attract illegal transactions or money laundering by bad actors. Governments are still figuring out how to regulate crypto, and policy changes can affect adoption and prices. There are many scams, fake websites, or promises of guaranteed returns. Once you send coins to a scammer, you often can't get them back, because there is no central authority managing crypto. When something goes wrong, there's usually no one to help reverse your transaction. Crypto transfers are typically irreversible, unlike bank transfers, so always double-check addresses before sending. Protect yourself. Verify URLs, be wary of DMs, enable 2FA, never share your recovery phrase, and keep larger amounts in a safer wallet. So crypto offers exciting opportunities but also serious risks. Understand both sides before getting involved. The answer depends on you, your goals, risk tolerance, and understanding of how it works. Don't rely on one video. Always do your own research and understand the risks before investing. Avoid jumping in from fear of missing out. Decisions driven by emotion can lead to costly mistakes. If you want deeper dives, like proof of stake, wallets, and security best practices, tell us which topic you want next. Thanks for watching, and if you want more videos that explain crypto clearly, like and subscribe.